Let's start with the embarrassing and work our way towards the ones that took entire countries down with them. Number 10, IndyMac Bank. 2008, this is IndyMac. In 2008, it was one of the largest mortgage lenders in the United States, with $32 billion in assets and a business model built almost entirely on a category of home loans called Alt-A mortgages. These were loans given to borrowers who couldn't fully document their income, which is a sentence that should have concerned more people than it apparently did. IndyMac's specific specialty was something called liar loans, a name the industry itself used, cheerfully, for years. These were mortgages where borrowers simply stated their income without providing any proof, and the bank accepted whatever number was written down. IndyMac then packaged these loans into securities and sold them to investors. The whole system worked perfectly as long as housing prices kept rising and nobody checked anything. In June 2008, Senator Charles Schumer released a letter expressing concern about IndyMac's financial stability. Depositors read it, panicked, and withdrew $1.3 billion in 11 days. The bank run was so severe that the FDIC had to physically send agents to branch locations to manage the crowds forming outside. The FDIC seized IndyMac on July 11, 2008. It was the second largest bank failure in American history at the time, costing the FDIC Deposit Insurance Fund approximately $13 billion. Employees were told the news on a Friday afternoon, which is the traditional time for delivering information that cannot be argued with over a weekend. Thankfully, the loans were called liar loans the whole time, so technically there were no surprises. Number 9. Continental Illinois. 1984. In the early 1980s, Continental Illinois was the 7th largest bank in the United States, with $40 billion in assets and a reputation as one of the most aggressive and innovative commercial lenders in the country. Businessweek named it one of the most well-managed corporations in America in 1981. 3 years later, it was the largest bank failure in American history. The collapse began with a smaller bank called Penn Square, an Oklahoma institution that had spent several years making enormous loans to oil and gas companies during the energy boom, and then selling portions of those loans to larger banks. Continental Illinois had purchased roughly $1 billion of Penn Square's energy loans. Penn Square failed in 1982. Their energy loans turned out to be almost entirely worthless, largely because the people approving them had occasionally been drinking beer from a cowboy boot during the approval process. This is a documented detail, not an embellishment. When Penn Square collapsed, Continental Illinois absorbed the losses and limped forward. Then in 1984, a Japanese newspaper reported that Continental was close to insolvency. The report was partially inaccurate. It didn't matter. Within days, institutional investors and large depositors pulled $10 billion from the bank electronically, which was the 1984 version of a bank run, conducted in suits and via wire transfer rather than outside on a sidewalk. The federal government stepped in with a $4.5 billion rescue package, the largest federal bank bailout in American history at that point, and effectively nationalized the bank temporarily. The phrase, "too big to fail," entered the American financial vocabulary specifically because of Continental Illinois, which is a significant legacy for a bank most people have never heard of. Number 8. Washington Mutual. 2008. Washington Mutual, known as WAMU, was the largest savings and loan institution in the United States with $307 billion in assets. It had survived the Great Depression, 2 world wars, and multiple recessions across its 119-year history. It lasted 11 days into the 2008 financial crisis before being seized. WAMU's collapse followed the same basic architecture as IndyMac, except larger in every direction. The bank had aggressively expanded into subprime and adjustable-rate mortgages throughout the mid-2000s, incentivizing loan officers based on volume rather than quality. The internal sales culture reportedly prioritized closing loans over evaluating whether borrowers could actually repay them, which turned out to be a relevant detail. When the housing market collapsed, WAMU's mortgage portfolio deteriorated so quickly that depositors withdrew $16.7 billion in 9 days. The Office of Thrift Supervision seized the bank on September 25, 2008, and sold its banking assets to J.P. Morgan Chase for $1.9 billion. J.P. Morgan acquired $307 billion in assets for $1.9 billion. For context, that is roughly the price of a moderately sized office building in Manhattan for the largest thrift institution in American history. WAMU shareholders and bondholders received nothing. The holding company filed for bankruptcy the following day. 4,300 employees lost their jobs in the same week that their employer ceased to exist. Thankfully, J.P. Morgan got a good deal. Number 7. Bank of United States. 1930. The Bank of United States failed on December 11, 1930, becoming the largest commercial bank failure in American history up to that point. With $200 million in deposits and over 400,000 depositors, most of them working-class immigrant families in New York City, who had chosen the bank specifically because of its name. assuming, reasonably, that a bank called the Bank of the United States had some official government connection. It did not. The failure triggered immediate panic across New York. Crowds gathered outside branches. Lines formed around entire city blocks. The images of depositors waiting outside closed bank doors became some of the most reproduced photographs of the early Depression era. The deeper tragedy is that the bank was almost saved. A consortium of larger New York banks organized by the Federal Reserve Bank of New York came close to agreeing on a rescue package in the days before the closure. The deal fell apart, reportedly in part because of resistance from institutions reluctant to backstop a bank whose depositor base was predominantly Jewish immigrants. The bank's failure accelerated a broader wave of bank runs across the country and contributed directly to the contraction of the money supply that deepened the Great Depression. The Federal Reserve, which had the tools to intervene more aggressively, largely did not. An estimated $172 million in depositor funds were eventually recovered through liquidation. The people who lost the rest had no federal deposit insurance to fall back on, because the FDIC would not exist for another 3 years. Number 6, Silicon Valley Bank, 2023. Silicon Valley Bank failed on March 10, 2023, becoming the second largest bank failure in American history with $209 billion in assets. It took approximately 48 hours from the first sign of public distress to complete collapse, which set a new unofficial record for the speed at which a large American financial institution can disintegrate in the age of mobile banking and social media. SVB's client base was almost entirely technology startups and venture capital firms, which meant its deposit base was unusually concentrated and unusually wired. When concerns about the bank's financial health began circulating in a venture capital group chat on the evening of March 8th, prominent investors began advising their portfolio companies to pull deposits immediately. The underlying problem was a duration mismatch. SVB had taken in enormous deposits during the tech boom of 2020 and 2021 and invested heavily in long-term government bonds when interest rates were near zero. When the Federal Reserve raised rates aggressively throughout 2022, those bonds lost significant market value. SVB was sitting on roughly $15 billion in unrealized losses on a bond portfolio it had never expected to sell. When they announced a capital raise to cover those losses on March 8th, the announcement itself triggered the panic it was trying to prevent. Depositors attempted to withdraw $42 billion in a single day. The bank's systems could not process the volume. The FDIC seized SVB on March 10. 2 days later, Signature Bank failed for related reasons. The Treasury, Federal Reserve, and FDIC jointly announced that all depositors at both banks would be made whole, including those above the $250,000 FDIC insurance limit, in a decision that generated significant political debate about who exactly gets rescued and under what circumstances. The debate is still ongoing. Number 5, First Republic Bank, 2023. The fact that 2023 gets 2 entries on this list is remarkable and not in a good way. First Republic Bank was a San Francisco-based institution with $229 billion in assets, built on a business model of providing low-rate jumbo mortgages and white-glove private banking services to wealthy clients. It was, by most measures, a conservatively run bank serving a financially stable clientele. It failed anyway. The SVB collapse in March 2023 triggered a crisis of confidence across regional banks, and First Republic was caught in the crossfire. Its wealthy depositor base, almost entirely above the $250,000 FDIC insurance limit, had every incentive and every technical capability to move money instantly. They did. 11 large banks, including JP Morgan and Bank of America, injected $30 billion in deposits into First Republic in March to stabilize it. The stabilization lasted approximately 6 weeks. By April, First Republic had reported that depositors had withdrawn $100 billion in the first quarter. The stock dropped 97% from its 52-week high. On May 1, 2023, regulators seized the bank and sold it to JP Morgan Chase in a deal structured over a single weekend. JP Morgan, which had helped rescue First Republic 6 weeks earlier by depositing $5 billion, now acquired $229 billion in assets at a significant discount and received loss-sharing agreements from the FDIC on top of that. It was the third largest bank failure in American history. JP Morgan's CEO Jamie Dimon announced the acquisition by saying, "Our government invited us to step up, and we did," which is one way to describe purchasing a $229 billion bank at a discount after a weekend of negotiations. Number 4, the savings and loan crisis, 1980s, 1990s. This one is not a single bank failure. It is over 1,000 of them, which is why it gets its own entry. Between 1986 and 1995, more than 1,000 savings and loan associations in the United States failed, costing taxpayers approximately $132 billion in bailout funds, roughly $300 billion in today's dollars. It was the largest collapse of American financial institutions since the Great Depression and remained the most expensive financial rescue in American history until 2008. The short version is that Congress deregulated the savings and loan industry in the early 1980s, allowing institutions that had previously been restricted to making home loans to suddenly invest in commercial real estate, junk bonds, and other high-risk assets while maintaining federal deposit insurance on all their deposits. This is the financial equivalent of giving someone a casino credit card and then guaranteeing all their losses personally. The most spectacular individual failure was Lincoln Savings and Loan, run by Charles Keating, whose collapse cost taxpayers $3.4 billion, and whose investors, many of them elderly retirees who had been told they were buying safe instruments, lost their entire savings. Keating was convicted of fraud and racketeering, served 4.5 years in prison, had his conviction overturned on a technicality, and was never retried. 5 U.S. senators, known as the Keating Five, were investigated for improperly intervening with federal regulators on Keating's behalf after receiving a combined $1.3 million in campaign contributions from him. One of them was later elected to the presidency. Thankfully, the deposit insurance system worked exactly as designed. The taxpayers covered everything. Number 3, Lehman Brothers. 2008, on September 15, 2008, Lehman Brothers filed for bankruptcy with $613 billion in debt. It remains the largest bankruptcy filing in American history and the single most consequential financial institution failure of the modern era. Lehman had spent years at the center of the mortgage-backed securities market, packaging and selling financial products built on home loans of increasingly questionable quality. By 2008, Lehman had accumulated enormous exposure to subprime mortgages and commercial real estate at precisely the moment both markets were collapsing simultaneously. What makes Lehman historically distinct from every other failure on this list is not its size. It is the deliberate decision by the federal government to let it fail. Bear Stearns, a smaller investment bank, had collapsed 6 months earlier, and the Federal Reserve had arranged an emergency rescue through J.P. Morgan. When Lehman reached the same point, Treasury Secretary Hank Paulson and Federal Reserve Chair Ben Bernanke decided, for reasons that remain debated by economists, that a rescue was not appropriate. The day after Lehman filed, global credit markets froze, money market funds broke the buck. The commercial paper market, through which ordinary companies fund daily operations, essentially stopped functioning. What followed required the federal government to commit over $700 billion in bailout funds through TARP and still produced the worst global recession since the 1930s. Roughly 26 million jobs were lost worldwide. American household wealth declined by approximately $13 trillion. Lehman's top executives collected over $1 billion in compensation in the 5 years preceding the collapse. These two facts exist in the same historical record, which is worth sitting with for a moment. Number 2, Credit Suisse 2023. 3 entries from 2023 on a single list is statistically improbable. Here we are. Credit Suisse was a 167-year-old Swiss institution, one of the 30 banks globally designated as systemically important to the world financial system, with $580 billion in assets. It was not a regional bank, it was not a niche lender, it was one of the foundational pillars of global finance. It was absorbed in an emergency weekend rescue in March 2023, 11 days after Silicon Valley Bank collapsed. Credit Suisse's problems were not new. The bank had spent the better part of a decade accumulating scandals at a pace that suggested either extraordinary bad luck or a profound institutional failure of risk management. The list includes a $5.5 billion loss from the Archegos Capital collapse in 2021, exposure to the Greensill Capital fraud the same year, a conviction for helping a Bulgarian cocaine trafficking organization launder money, an executive-level spying scandal, and multiple regulatory fines across multiple countries. By 2023, the bank had reported losses of $7.9 billion in 2022 alone, its largest annual loss in 15 years. When SVB collapsed and depositor confidence in banks globally evaporated overnight, Credit Suisse depositors withdrew $10 billion in a single day. The Swiss government arranged an emergency acquisition by UBS over a single weekend, with $9 billion in government loss guarantees and $100 billion in liquidity support. UBS paid $3.2 billion for a bank with $580 billion in assets. Approximately $17 billion in Credit Suisse bonds, called AT1 bonds, were written down to zero as part of the deal, wiping out bondholders entirely, while shareholders received partial compensation, which reversed the traditional priority of who gets paid first in a bankruptcy. Global bond markets spent the following week recalibrating what that meant for everyone else. Number 1, the Great Depression bank collapses. 1930 to 1933. Nothing on this list comes close. Between 1930 and 1933, approximately 9,000 banks in the United States failed. Not 9, not 90, 9,000. Roughly half of every bank that existed in the country at the start of the decade had ceased to exist by the end of it. Total depositor losses exceeded $1.3 billion in 1930s dollars, an almost incomprehensible sum for that era, and fell almost entirely on ordinary Americans who had no insurance, no federal backstop, and no recourse of any kind. The collapse was not caused by a single event or a single bad decision. It was a cascade. The 1929 stock market crash wiped out investment portfolios, businesses contracted, loan defaults rose, banks that had made loans to now failing businesses began to wobble. Depositors, seeing banks wobble, withdrew their money. Banks that lost deposits called in loans to cover withdrawals. Businesses that had their loans called in failed, which caused more defaults, which caused more bank wobbling. The Federal Reserve, which existed specifically to prevent this kind of cascade, raised interest rates during the crisis. This is the equivalent of treating a patient losing blood by removing more blood, and its consequences are studied in economics programs to this day. By 1933, industrial production had fallen by 47%, unemployment had reached 25%. 1 in 4 Americans who wanted to work could not find work, in large part because the banking system that funded the businesses that provided the jobs had simply ceased to function. Franklin Roosevelt closed every bank in the country for 4 days upon taking office in March 1933, a period called the Bank Holiday, during which Congress passed the Emergency Banking Act and the framework for the FDIC was established. When banks reopened, the run stopped. The announcement that deposits would be insured was enough. The entire catastrophe, the loss of 9,000 banks, and the financial destruction of a generation of ordinary Americans was ultimately addressed by a promise. It just came about 3 years too late.